A 42% oil jump from roughly $67 to about $95 a barrel can erase a 3% raise before your paycheck has time to brag about it. If that shock turns into $4 gas, your commute, groceries, utilities, deliveries, flights, and credit card balance all start fighting over the same paycheck. And here is the part Wall Street loves to shrug off. A trader can price in a ceasefire headline by lunch. Your household budget gets repriced one receipt at a time for months. Markets move first, gas stations move next, grocery shelves move after that. Debt statements show up last like the final boss nobody asked for. So the question is not just, will oil hit $100? The question is, can your budget survive long enough for the headline panic to fade? Here is the practical map, not the cable news version and not the geopolitical risk premium word salad. The version that matters if you were trying to keep bills paid, protect emergency cash, keep investing, or stay on track for coast fire. Coast fire simply means your investments are far enough along that if you leave them alone, time and compounding can do a lot of the retirement work for you. An energy shock threatens that because it tempts you to raid cash, cut contributions, or use debt as the household shock absorber. Oil shocks are dangerous because they do not hit one clean line item. They hit the boring middle of your life, the tank you need to fill, the food you need to buy, the utility bill you cannot manifest away, and the card balance that starts as a temporary bridge and becomes a toll road. Start with a normal household, 2 cars, a kitchen table budget already doing gymnastics, and a commute that cannot be deleted just because crude oil had a dramatic week. Before the shock, the math was tight but possible. Housing, insurance, groceries, daycare, a small 401k contribution, maybe a Roth IRA when life behaves, and one takeout night because cooking after a 10-hour day is apparently not a core American value. Then the pump changes, maybe $8 more on one fill-up, then $12. Then the grocery run that used to be $165 becomes $187, and nobody bought lobster. The delivery app adds a fuel surcharge. The electric bill looks heavier. Flights to visit family jump just enough that the trip goes from annoying but doable to why is it $1,400 to sit in a middle seat with pretzels? And because this is America, there is probably a credit card in the background charging interest like it went to business school and learned nothing but confidence. That is the receipt version of an oil shock. Gas first because the number is on a giant sign, then groceries, then delivery fees, then utilities, then travel, then debt. Because when cash flow gets tight, plastic becomes the unofficial shock absorber. Wall Street can say, maybe this is temporary. Your budget does not get to trade maybe. Your budget has to pay Tuesday's fuel price with Friday's paycheck. The Dallas Fed has estimated that under a current supply shortfall type scenario, headline PCE inflation could be about 0.6 percentage points higher, while core PCE could be about 0.2 percentage points higher. Caveat, because credibility matters, those are scenario estimates, not destiny. The damage depends on how long disruptions last, how quickly shipping normalizes, and whether the conflict gets worse or cools down. But the direction of pain is clear. PCE is one of the inflation gauges the Fed watches when deciding whether prices are cooling enough to cut rates. Percentage points may sound tiny until they apply to your whole cost of living. If your wages rise 3%, but inflation moves from around 2.4% toward 3% or higher because energy pushes through the system, your paycheck can be larger on paper while your life gets smaller in practice. That is the insult. Your boss says you got a raise, your bank account says, cute, try again. Now zoom out to the narrow channel behind this, the Strait of Hormuz. Do not treat it like a map trivia question. A disruption there can affect roughly 20% of global oil supply, plus major liquefied natural gas flows. Americans do not need to buy Iranian oil directly to feel this because oil is globally priced. When a major supply route gets riskier, traders bid up the price. Refineries, shippers, airlines, trucking companies, farms, and retailers all start doing their own math. Eventually, somebody tries to hand that cost to the customer. Usually, that customer is you. This is why a ceasefire can look like good news on financial TV and still feel weak in real life.
Oil may pull back because traders price in lower odds of disaster.
Stocks may bounce because investors think the worst-case scenario is less likely. But your grocery store does not reprint every shelf tag because a diplomat sounded optimistic at 2 p.m. Your credit card issuer does not lower your APR because crude had a calm morning. The market gets instant pricing. You get delayed billing. You may hear someone say, but core inflation excludes food and energy, so why does oil matter? Good question. Also, congratulations, you have found one of the most annoying phrases in economics. Removing energy from the label does not remove energy from the economy. Oil costs show up in transportation, groceries, airline tickets, delivery fees, manufacturing, packaging, maintenance, and services. That chain is called pass-through. A cost starts in one place and gets handed down the line until it reaches someone with less bargaining power. Usually, that someone is you. Now move this into a monthly budget. The dangerous part is rarely one giant bill. It is 5 small bills getting worse together. Gas may cost $20 to $60 more per month depending on your commute and vehicle. Groceries may add another $40 to $100 if freight and food production costs keep pushing through. Delivery fees, utilities, airfare, and car costs can tighten at once because apparently every bill in America has decided to become a growth stock. Then add debt. The New York Fed reported U.S. household debt at about $18.8 trillion in the first quarter of 2026. That matters because when households already carry debt, a price shock does not just reduce comfort, it can push balances higher. If you have no credit card balance, a $200 monthly squeeze is painful. If you already have a balance at 22% APR, that same squeeze can become a trap. APR is just the price of carrying debt for a year. A 22% credit card APR is basically the card saying, I will help you survive this month, and then I will tax your breathing room next month. Lower-income and middle-class Americans feel it first because necessities take a bigger share of the paycheck. A higher-income household may complain about premium gas and still book the flight. A lower-income household may choose between filling the tank for work and paying the utility bill on time. That is not a budgeting failure. That is arithmetic with fewer escape routes. This is where Coast Fire gets fragile. If your plan depends on investments untouched, continuing at least the employer match, and letting compounding do its slow, boring magic, then an energy shock attacks the boring part. It raises bills you cannot fully avoid. It tempts you to reduce contributions without a plan. It tempts you to carry a card balance so your lifestyle looks unchanged for another month. If the squeeze lasts long enough, it can make you raid cash or sell investments at exactly the wrong time. Wall Street reacts differently because Wall Street trades expectations, not grocery receipts. Energy stocks may rise when oil rises because their product becomes more valuable. Airlines, trucking companies, delivery-heavy businesses, and thin-margin retailers may get pressured because fuel is a cost. Bond markets may price in stickier inflation. When investors think inflation may stay hot, they often expect the Fed to keep rates higher for longer. Higher for longer is not just a Fed press conference phrase. It is why a family hoping to refinance, buy a car, or consolidate debt may stay stuck paying expensive interest. And then comes the ceasefire trap. A ceasefire headline can calm markets and take some panic premium out of oil. But shipping lanes, insurance premiums, tanker schedules, inventories, and trust do not normalize instantly. Prices can fall from the scariest number and still stay above the old normal. Panic to less bad is not the same as cheap. So, what can you actually do without pretending you control the Strait of Hormuz from your kitchen? First, audit your energy-exposed categories: commuting, gas, groceries, delivery, utilities, travel, and variable rate debt. For commuting, calculate the dollar cost of one workday round trip. If your car uses 3 gallons and gas rises $1 per gallon, that day costs $3 more, about $60 per month if you drive 20 workdays. If you can shift 1 day a week to remote work, carpooling, public transit, or batching errands, you reduce exposure to a price you do not control. Second, build a 60 to 90-day fuel and food buffer and cash flow.
not panic buying. It means you know which spending gets cut first if gas and groceries run hot. Delivery apps drop. Pickup replaces delivery. Convenience store purchases get cut because paying $4.29 for a drink next to the gas pump is not a personality trait. If your utility offers budget billing, remember, smoothing changes timing, saving changes the total.
Third, make the grocery response tactical, not emotional. Swap 2 or 3 staples to store brand for 60 days. Compare unit prices, not package sizes, because companies love shrinking the box and hoping your brain is busy. Separate food from food friction. Food is groceries. Food friction is delivery fees, gas station snacks, forgotten lunches, expensive drinks, and the $18 salad you bought because you were too tired to remember a sandwich exists. Fourth, treat variable debt like a leak in the boat. Prioritize credit cards, variable rate personal loans, and buy now, pay later obligations. Minimums on everything, extra dollars to the highest APR, unless clearing one small balance immediately frees up useful cash flow. If you have decent credit, compare a 0% balance transfer fee against your current interest cost. Use it as a payoff bridge, not permission to reload the card. Fifth, protect emergency cash before chasing oil headlines. When oil spikes, energy stocks can look tempting. A few green candles, and suddenly everyone thinks they're an oil trader because they own a brokerage app and a chair. Be careful. If your emergency fund is thin, your first investment decision is not whether to buy an energy ETF. It is whether you have enough cash to avoid selling long-term investments or adding credit card debt if prices stay elevated. Sixth, protect the parts of your Coast Fire plan that still work. If your employer offers a 401k match, think carefully before cutting below it. If you must reduce investing temporarily to protect rent, food, utilities, and debt payments, do it deliberately and put a review date on it. I am pausing extra contributions for 60 days while fuel and grocery costs reset is different from I stopped investing because everything feels terrible. Seventh, delay expensive optional commitments that become painful when rates stay high. Before taking on a new car payment, furniture financing, a vacation on a card, or a home project loan, ask one question. If gas, groceries, and utilities stay elevated for 90 days, does this payment still fit? If the answer requires optimism, the payment is too tight. This is not about living scared. It is about refusing to let a global energy shock write your household budget for you. The frustrating thing about oil shocks is that they punish people who did nothing wrong. You did not choose tanker routes. You did not negotiate shipping insurance.
You did not ask for geopolitical risk to add to eggs, airfare, and toothpaste, but you still have to respond faster than the bill collectors do. Watch gas prices first. Watch grocery totals next. Watch delivery fees, utility bills, and credit card balances. Watch market relief rallies with skepticism, because markets can recover before households do. That is the part Wall Street keeps proving. The chart can recover before your wallet does. The panic premium can fade before your grocery bill does. The headline can improve before your debt statement does. Financial markets are built to move on new information. Households are stuck absorbing old decisions, delayed prices, and bills that arrive on their own schedule. The market sees the oil shock first. The gas pump confirms it. The grocery bill spreads it. The debt statement reveals whether the household was prepared. And that is the point. An Iran war-driven energy shock is not only an oil story. It is a budget story, an inflation expectation story, a market behavior story, and if you are pursuing Coast Fire, a timeline story. You do not need to predict the exact oil price. You do not need to pretend you can trade every headline. You need to reduce exposure before every bill updates. Know your fuel number. Know your grocery number. Know which spending gets paused first. Protect emergency cash. Keep high-interest debt from becoming the shock absorber. And protect the retirement contributions that matter most, especially the match, unless the basic bills truly force your hand. Wall Street may shrug off the $4 gas shock when the chart starts looking less scary. Your budget does not get that luxury. Your job is to make sure a temporary energy crisis stays temporary in your own life. Not because the system is fair, it is not, but because every dollar you keep out of high-interest debt, every contribution you preserve, and every unnecessary payment you delay keeps more control in your hands. That is how you keep one global oil shock from becoming your personal financial detour.